I came across this post because I thought it was very timely, especially in today's market. Many have experienced the crash of 2020, and of course, people are always talking about, is the market going to recrash? Is the stock market going to collapse? There has been numerous videos talking about the job numbers, the state of the economy, etc., and how, if you look on social media or on YouTube, you can see that there's always forever a plethora of individuals talking about, will the market crash? Is it time to sell? Should you save yourself? Is it time to get out of your investments, etc.? And I came across this post because I thought it was actually very timely. It talks about confessions. I panicked. It cost me a lot. Don't let it happen to you, even if you have to pay for it. And he says, I panicked. I sold it all. I went to US Treasuries, lost 300,000 compared to doing nothing. I'm still not fully back into the market. Says, don't be like me. And I thought this was a really good point of what Warren Buffett said when he said the stock market is a device for transferring money from the impatient to the patient, right? So this individual became impatient, saw the market turning red, panic sold out of his positions to go into what he thought was going to be a safer bet, going into US Treasuries. And as a result, he literally, because of his impatience, transferred $300,000 worth of wealth to someone else. Instead of, as he said, literally, if he just did nothing, his portfolio would have gone up 300,000. But instead, he panic sold, and as a result, transferred that wealth from him, who acted in an impatient way, to someone who patiently waited for the market to come to them. So he goes on to say, we all know how it should work, right? You pick your asset allocation, you squirrel away, you rebalance, you do some Roth conversions, keep living costs low. Build a tent to mitigate sequence of returned risks and sail off into the sunset. I could go into why I decided to sell everything and buy US Treasuries, but by this time in my journey, I should have known better. This was a person who was not new. He was not new to investing. In fact, by his own admission, he says, by this time in my journey, I should have known better. So even the seasoned investor can have periods of points in their life where they go against what they know is in their best interest, which is to remain patient, to buy and hold, or at the very least to do things to mitigate loss, but never to just completely sell out of all your positions because you think the market is coming down. There's always going to be a correction. The market will continue to trade higher. Don't be the person, of course, who has their wealth transferred from you to someone else. He goes on to say, he says, fortunately, I had a plan to get back in, but by that time, he says, but that plan did not indicate re-entry until August 1st, 2020. He says, but by then, psychology was already working against my best interests. Can't get back in now, not near the highs. So I determined to invest in 5 chunks, right? So he would slowly piece his way into the market. As I set a limit orders for 2 to 4% off recent highs, and if those didn't trigger by month end, I would change them to market orders to ensure entry. Well, August saw no such pullback, 7% higher, right? So for all of those individuals who were saying, wait for the pullbacks, etc., that's what he tried to do. He made the mistake of getting out and said to himself, okay, the market crashed. Maybe we'll see a little bit of a pullback, so I'll wait. Wait for the pullback, and the pullback never came. 7% higher. What was he going to do? Well, he goes on to say, shoot, put in 1/5 and set orders for September, which all got filled yesterday in the sell-off. So he says, I'm back in about 40% of my standard 80-20 portfolio. I made a spreadsheet with my positions on March 31st, 2020. I compared that to the same portfolio on August 31st. The portfolio I liquidated was worth $1.4 million. the same portfolio would be worth 1.7 million untouched August 31st. So if he literally did nothing, he would have gained an additional 300,000 into his portfolio. But instead, he panic sold and had to pay up. He says, I missed out on over 300,000 of capital gains, to say nothing of the dividends that I missed out on, nor tax implications of what I did in March. Right? So he sold out of his positions. No doubt he was up in his portfolio, but now he's got to pay the taxes. Right? So he goes on to say some perspective. The money invested would have paid for college tuition for my 2 children just about anywhere for 4 years when they turn 18. That loss will likely push off my retirement roughly 3 to 5 years. Or if I keep the same target date, I'll have to spend $25,000 less during my years of retirement. Or I could have just quit my job, bought a yacht, and sailed the world for the last 5 months, and I would have been better off. I know we like to say that financial advisors are too expensive, not worth it, etc. But someone who had simply said, don't be a muppet and stay the course, would have earned 19 years worth of fees. This is the behavior gap. The difference between what an asset class earns and what an irrational, fearful investor earns investing in the same asset class. It is real. It is expensive. Good luck closing it. He says, stay safe out there. Learn from my stupidity. I hope I have. And so you're actually looking back at the stock market. I mean, I can't imagine individuals who were investors back in the early 80s who, when they saw the market ramp up from, 800, when the Dow was 800, all the way to almost literally tripling the level of the Dow. And how many people that were out there that were saying the market is overstretched, it's time to get out, you need to sell everything. And then when the market crashed, subsequently sold out of their positions, right? Selling out on the lows of 1987 just to see the market ramp all the way back up. And this is the history. This is the history of the stock market, that there are always highs and lows, peaks and valleys, where areas of crashes, and then the market trades higher because companies start to earn more money. More, the population grows, you get more people who are buying into the stock market, and of course, market goes up. I mean, you can look back into the history of the chart on the Dow, and you will always find peaks and valleys. You'll always find peaks and valleys. How many people were saying the stock market, when it was 180 and went to 500, would someone who was investing here probably left all that money to their grandchildren. But this is how you build. This is how you build generational wealth. This is the buy and hold strategy does work, but it's a very slow strategy. So my advice, especially for a lot of you individuals who are new to investing, as this individual said, that through the peaks and the valleys that we will experience as long-term investors, remember what he said. Stay the course.